The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.
Hey everyone, thanks for joining us again in another episode of In the Market Trenches. Really happy to have you. We're really excited about this episode. We have a special guest for you. Before we get to that, you can follow us on our blog, www.accretivewealthpartners.com. We have a Facebook, we have a LinkedIn. You could download our podcast and subscribe anywhere podcasts are available. We're also on inthemarkettrenches.podbean.com. You could also find us on snn.network or the SNN YouTube channel, which is youtube.com/SNNwire. So with that, I'd like to turn it over to Gary to introduce our guest. Gary, take it away.
Okay, well, we have a special guest today, a good friend of mine from business school. We met, probably in the trenches about 10 years ago. So he's on to talk to us about one of his many adventures. He's a small microcap investor, value investor, neither of which seem to be particularly in favor today, but he's going to be educating us on some of his past experiences because, I'm sure both of those styles will come back into vogue at some point in the future. So without any further ado, Peter Rabover of Artko Capital. Peter, welcome.
Hey, thanks. Hey, thanks for having me, Gary, Eric. I appreciate it. And Gary and I have been friends for a long time. We've met like the first few weeks of business school, and we were in the same section, and kind of we're both value investors. So which was somewhat rare in our business school class. So we kind of hit it off.
Yeah, we were part of Artko Capital Management, which was the student-led investment program. And Peter had the misfortune of hearing all of my ideas through business school, the good, the bad, the ugly, and everything in between. So let's see. So Peter, I know a lot about you. As I mentioned, we met at the University of Virginia's Darden School of Business, did their capital management program, everything else like that. But why don't you tell us a little about yourself, how maybe a little bit before you got to business school, how you got interested in investing, what kind of investor you are, and what got you to Artko and where you are today.
Sure. Thanks for asking. So about little over 20 years ago, I was an undergrad at Duquesne in Pittsburgh. And this was right around the stock market bubble, which is not dissimilar to today's behavior. But I was too young and I didn't really realize the implications at the time. But I was looking for majors, and one of my professors gave me a theory of finance textbook. And so I read that cover to cover, and kind of boring, but I enjoyed it for the most part, except the efficient market hypothesis. That didn't really sit well with me, and I just couldn't wrap my mind around it. And
now, Peter, remind me, are you the most notable alumni of Duquesne in the investment world? Is that you? I heard it was.
No, I don't think so. I think we're thinking of different Duquesnes, not Duquesne Asset Management, but Duquesne University. So, and I don't know. I think we had some notable alumni that are probably a little quieter. And then the guy gave me the Warren Buffett letters, and Peter Lynch's One Up on Wall Street. Both of those like really resonated with me, and so it was like one of those natural things where I'm like, oh, I get it, like buying cheap companies, and then people will recognize that they're too cheap and bid them up, and I'm like, this seems like a challenge. And I was a former Division I wrestler looking for a new challenge at the time, and I was like, oh, this is perfect. So that was sort of my background, and I've always wanted to do what I'm doing now. I was a little didn't get there right away after college. I was in the Peace Corps, and I did some M&A for U.S. Steel, got my CFA charter, and then along with business school, I was lucky enough to work for a large cap value and a mid cap value fund, which we'll talk about in context of microcaps and leverage in a bit. But those were just very good experiences, and both in the middle, after the bubble and the financial crisis and the last 10 years. And so I've always wanted to run my own investment partnership. So I've launched Artko Capital a little over 5 years ago. We've done pretty well, not this particular year, but I'm confident it's a temporary once the mania dies down. And yeah, and so we invest, our average market cap's like 70, 80 million. And it's pretty concentrated. We have 11 positions. The biggest ones are like 15%, and which does make it very volatile and not particularly enjoyable in situations like this, but it's a good risk reward. And so one of the things that there's a lot of risks in microcaps. Like a lot of them will go down to zero for various reasons. And we'll talk about one later in a bit, but the way I try to control for that risk, and again, this is all relative to like a mid cap or a large cap, is I stay away from leverage. Microcap managers do not know how to manage debt. I try to make sure that we're incentivized. So the CEOs or the co-founders have at least or insiders have, 20, 25%. I think our average is 25%. It's about $20 million at risk for these people. And because you just don't know, you want somebody to be incentivized not to make these things go to zero. And so,
right.
And so those are kind of the big ones. And I think the strategy really involves buying things.
I mean, one of the things I've noticed over time is that these microcap management teams they're not necessarily the A+ management teams. So them having some skin in the game, at least it's their own money that they're risking, right? Is that sort of the idea?
Yeah, I mean, like, look, in the past, I've been somewhat. I've given passes to management teams that didn't have as much, and that has both worked out and not worked out. But interestingly enough, the Hudson Technologies one that we'll get into later was a very incentivized management team that was just didn't work out. The real strategy of the fund is to buy things at balance sheet prices that are, whether the companies are trading in assets that or prices that are reflective of what they have on the balance sheet, but not reflective of what they have on the income statement, and hoping that what they have on the income statement will become apparent within our holding period, 3 to 5 years, and that will cause the stock to trade as a going concern rather than the NAV of the balance sheet. And so that's that's worked out in the past, and in microcaps there's a lot more opportunity to do that.
Yeah, no, that sounds good. So if I'm going to summarize what you're looking to do with companies that you're involved in, you're looking for asset protection that can sort of turn in a balance sheet story that can turn into an income statement story over the next couple of years. Is that a fair characterization?
Yeah. Yep.
Cool. Let's see. So, Eric, do you have any questions before we dive into the case study?
So what was the toughest part of transitioning from the large and mid cap space to the micro cap space?
Yeah, I mean, like, it's hard to describe, but I think I was the mid cap company that I worked for, a really good company called Hudson Capital Management, and my boss let me interview hundreds of management teams. And for the large cap one, we didn't do as much. My boss didn't really believe in the large cap in the interviewing the managers, but I still got to interview enough. And it's just, these are like Harvard Business School graduates or Darden graduates I certainly had a few Darden CEOs that I've spoken to in the past, and they're higher quality. They think about things like cost of capital and capital allocation, and and a lot of these small microcap teams, and not that they're not smart, they're just like, they're more naive, right?
Sure.
I find after a couple of years that proving to the CEOs that I am clearly a shareholder and I'm friendly, a lot of times they email to me and start asking me for advice, like what we should do here and what you think of this, and you just have to not be a jerk, and then management teams will talk to you and actually lean on you for for advice. I find there are some people that are like, oh, you need to be this huge manager to get access to management. I'm like, man, I got three emails in my inbox from CEOs of my companies that I don't have time to answer this week. So it's a little different. So I would say that's probably one of the bigger differences is access is significantly easier than you think, and their levels of experience or understanding of how to be a grown-up public markets company is probably a little less sophisticated. So those would be the big ones.
Cool. Yeah, you want to jump right into your story?
Yeah, sure. I mean, I think the title or the concept here is in the trenches, and we can talk about horror stories. I find this one like somewhat fascinating because to this day I'm still not really sure why things went wrong or what. Well, I can tell you why they went wrong, but why the market didn't react the way it should have. But basically, the story is Hudson Technologies, and it was what they did was, or do, is they sell the refrigerant gases for air conditioning in freezers. Mm-hmm. And there's two ways to buy those gases, and there's virgin gas that's produced in-house, and then there's reclaimed gas that's you collect from your air conditioners, and you send that to the company, and then they process it, and then they resell it to you. And the premise there was that because of all of the environmental laws, and the EPA had an industry-wide sunset that was supposed to phase out the virgin gases, and only gases you could buy were the reclaimed gases. And clearly that would make the reclaimed gases much more valuable if the available supply goes down while the installed base of air conditioners sort of stays relatively the same or declines a lot slower. And and the company was founded by essentially the guy who founded the industry. I think he had like 25 million at stake. The company had a clean balance sheet, and for the only rumor there was that and I just could not ever confirm it, that there was all these stockpiles of all this gas out there. It's just sitting in people's warehouses. It was like the shadow stockpile, but the gas prices were for many years were like $3, $4, $5, $6, and so for 2 years.
Shadow inventory of let me just jump in. Shadow inventory of this company's product, or this company and a bunch of other competitors out there. There was just an oversupply for the industry.
It was oversupplied for the industry, but like I said, keeping in mind this company. So it was a pretty concentrated industry, and so I think these guys had like 25%. Market share, and then there was Air Gas and National, and I think together they owned like 70 to 80%. So there was an oligopolistic behavior, I guess, in a way that was sort of, once again, you're thinking that it was irrational market, that the players were rational, right, in that situation. And so for a few years that worked. The price jumped up to from like $3, $4 to 6 to 8, then all the way to like 16 to 18 for a couple of years, right? So there was 2 summer seasons that worked really, really well. And so my thought, and keeping in mind that the price of that gas was in the low mid-single digits for like a half a decade. So whoever was been holding that shadow inventory, right, must have been paying warehouse fees, et cetera, for years. Right. And so all of a sudden that you had the spike in prices because the market just started freaking out about the virgin phase out. And we're talking about the R22 refrigerant gas market. And, to me, it was really weird that I had to assume that if there were rational players in the market, that during the 2 summers where the prices were above $10, that they would start to sell their inventory that they've been holding, right, in those warehouses for years. And once again, really hard to confirm. There was a guy out there that was who hated Hudson Technologies, so he was spewing a lot of false things to the short sellers, and so he was kind of compromised bias. So he was not he was kind of the little boy who cried wolf a lot of times, and you were sort of, he had less belief, but you know, in the end, I guess he turned out to be right. But essentially what had happened was the stock price was high, the R22 price was high, and the CEO decided to merge the company with Airgas, or Airgas sold their division to them, and all of a sudden, you know, they would own like 50-60% of the market, and you know, it seemed like a really good idea at the time, except that, you know, they used leverage to it had a clean balance sheet before, and so they used leverage, a significant amount of leverage, to make this acquisition. And so here you had to assume that a very incentivized CEO who had $25, you know, $30 million of his own money, essentially ran the industry for 30 years, knew all the players, and presumably he had, at this point, would have control of the industry in some ways. Like he could control the inventory, or couldn't control the demand, but could at least control the supply. And so you have to assume that he was making the right decision in making this acquisition. It seemed like a really good, like, you know, the stock jumped for like a whole day on the acquisition, and then things started to go wrong. And then like whoever. So
let me jump in right there,
yeah.
Peter, and ask you a question. Were you involved pre-acquisition and then this happened, or did the acquisition spur you to take a look at it?
No, I was involved in pre-acquisition. It was very, I was buying it at very low prices at the time. The stock price, I'm not going to name it to you, but
what was the market cap roughly?
What did I say, like $70-80 million, like off the top of my head? I could be.
All right, so if the CEO owned $25-30 million, I mean, he owned a good chunk.
Maybe it was 100. Yeah, because I remember.
Yeah. Okay.
Because I remember he had over, the figure that I remember is it was 20, when I bought in, he had $25 million at risk at that particular time. Like, right. And so.
And can I back up and ask an even like dummy type question? How'd you find this one? And how did your search strategy help turn it up?
Yeah, I think that one I might have been, that was a screen. I think it was like a free cash flow balance sheet yield screen. And I think they started to have a good year. So all of a sudden, I think it was like a 30% free cash flow return on assets or something. Like, yeah, so it was a cash flow ROA screen. And so that's how they popped up, and it was like cash flow ROA and insider ownership and clean balance sheet. And I think that sort of popped up, and I was looking at it, and I remember being very excited because I bottom ticked it for like getting my what I thought at the time was the bottom, but you know, like it ran up significantly after that. So
right.
And so I certainly felt like a genius.
Okay, so you found it, you bought some, they do this, what looks to be a transformational deal, largely financed with debt, if I'm understanding you correctly.
They did a small secondary IPO, and you know, the other thing I can tell you is no company of mine over the last microcap company that has done a secondary whose price didn't decline 50% after exist. So if you have a microcap and they do a secondary, probably a very bad signal. You know, it's an obvious statement, but I can tell you, you know, and it works pretty well for large caps, like, you know, you can, you know, Elon and Tesla and whatever, but microcaps just goes terrible. So don't do it.
Yeah, I mean, that's one of the things I've noticed about these microcap. I mean, I don't know about you, but one of the things I've noticed about these microcap management teams is they're not very good at sort of the capital stack and how they deal with it. Yep. And they can get a pretty messed up capital structure pretty darn quick. Either there's a convert in there, or some warrants with a lot of dilution, or they don't do a good job issuing stock or retiring stock. It's like just not something that they think about normally. I don't know if your experience has been any different, but that's certainly been mine.
Right. And well, the other thing that sort of happens is a lot of them are undercovered, like by Wall Street. And so, you know, to a certain extent, I know how that pitch goes, but you'll get like one of these bucket shops investment banks, or at least like somewhat respectable small tier investment banks come like maybe like a William Blair or something like that come in, and they'll start whispering in their ears like, hey, let's do the secondary, we'll do some of these acquisitions for you in this space, and it'll be really good, we'll get you Wall Street coverage. And like that essentially happened with USA Technologies. That's a whole other horror story that we can talk about, but with leverage and acquisitions. But
maybe we could talk about that one another time. Isn't that the one where the guy followed you out of a conference?
Oh yeah, well no, during the call he wouldn't answer my calls or emails. He did a secondary even though he told me he wasn't going to, so wouldn't answer why he did it. So during the conference, during the Q&A, I raised my hand and asked him, and like, hey, why did you do the secondary? Like, right? And he wouldn't really answer. And then somebody else asked him that, so he felt really embarrassed. And then he just took, as soon as the webcast was over, he took off after me and chased me in the hallway and started screaming that why I embarrassed him on the webcast like this. And I'm like, like you're not answering my questions, like, right? So the company blew up very significantly because of him. So I feel pretty vindicated in that particular situation.
That's a good story. We'll have to have you back another time to tell the full one.
Yeah.
That sounds like that could be fun.
And so I would say secondary. So they financed it with a secondary and debt. And so like, look, the premise there is like, the guy knows his industry. He has to know what, like, if there are shadow inventory, clearly he should understand this, like, right, that there is, and at least he would have seen this happen. And then, like, look, some short reports came out that at first my psychological response were like, these like sons of bitches, they're like, they're just doing this manipulation thing, and a lot of them had bad points, which were, I knew for a fact, not true. So that made me dismiss the more valid points in those reports. But realistically, they claimed that they acquired a significant amount of overpriced inventory from Airgas. Essentially, the deal was that Airgas was just dumping inventory on Hudson at significantly higher prices, and that was the deal, and they used leverage to buy it. And not the worst thesis, and it was partially correct. And so hold on. One of the things that Hudson had to do is had to write off a lot of the inventory that they bought from Airgas. So you had a question.
Yeah. Did it give you any pause that Hudson was acquiring Airgas's business and it wasn't sort of the other way around?
No, because like I said, the CEO was like the industry. He didn't want to sell. He wanted, because in his mind we were just entering like this new growth phase of the R22 gas situation, and they were and there were all these other gases that were also coming off. EPA was going to phase them out, and they had all these other things that they could get into it. So he was pretty excited about where the industry was going and what the opportunity was, and he was just trying to consolidate it and leverage these gains for himself. I felt like, and this was not. It was a very tiny part of Airgas. Like Airgas is this giant, large cap. And this was a pretty small deal, which was maybe like $200 million, like off the top of my head, something like that. It was almost a merger. So it was almost like yeah.
Keep going. Sorry.
No. And like I said, it just like it. Maybe I was naive in retrospect, but it did make a lot of, once again, logical, economical sense. And this guy was at least one of the smarter people that I've spoken to whenever we'd have calls that at least understood the market, or it sure seemed like it. And so we were in this phase of about 6 months where these reports were coming out, and all of a sudden the prices started, coming down. That season, whatever the year it was, maybe 2018, somewhere, maybe summer 2017 or 2018, I think was the summer. And they were, the prices went from $18 to like 12, 13, 11. So obviously down, but still very profitable for certain segments, but clearly was lot less cash flow to go around on for servicing the debt, and so the kind of
So
like really.
So if I could frame this up, you have a $100 million company that did a $200 million acquisition.
No, because they were. I told you they ran up like 200% since then, so they were like a $300 million company at that point.
Got it. So it looked like more like a merger of equals at the time, which is
right.
almost never the case. But they certainly like to be spun that way. Okay. And this was all debt financed primarily,
or with a little secondary that they did before this, because I think they were the interesting thing there was that the National, Airgas, Hudson, and National were all about equal in market share, and National was had a dying founder or something like this at the time, and so the premise for that secondary that they did this, but they were going to buy National, not Airgas. The Airgas thing was kind of a surprise, but sure, like, you know, either one will work fine, and so I think they probably gave him better terms on the Airgas thing. So
got it. It seems like a key issue for them with the amount, in addition to the amount of debt that they took on, was perhaps they didn't control the input cost of what it was that if you think about income statements, it's price, volume, margin, and maybe they had some good insight into volumes, but the pricing was an element of this that they had. Did they essentially have no control over?
Well, they essentially bought. Right, and so look, it talks about input costs. Like, they essentially, you either recognize those input costs as cost of goods sold or inventory, or you buy them at like the significantly high price and you recognize it as inventory write-downs, like on somewhere along the income statement. But either way, those were high input costs that they bought, and so so the real wake-up moment came for me, because I was reading these short reports and I was kind of annoyed about it, but I was like, what if they have a valid point? Like, if they are right, then I am kind of really screwed. So I decided to hedge the position. We're not going to talk prices or whatever, but they had this call. I think it was the second quarter of 2018, which like July sometime, and they said these two things on the call that were so eye-opening for me that it was kind of unbelievable. They said, somebody asked them what their view on prices and inventory or whatever the market dynamics was, and the guy essentially said, oh no, like, we have very little visibility in what we're doing, and we're just, we think the prices will stay flat, at least, or where they are today, $11, $12, $13 per pound. And I was like, wait a minute, like, you just merged with, like, you just made, like, you're half the industry, essentially, a little more, and you're telling me you don't have visibility into your own market, and you clearly just, you did this with a lot of debt, so, like, that was like a really red flag. And then, like, 5 minutes later, somebody pops onto the call and says, hey, have you guys thought about covenants? Like, what happens if these with your debt covenants? And they're like, oh no, we haven't thought about that. That's not like something that we've been concerned about. So flash forward 2 weeks later, they had to start issuing covenant modifications with JP Morgan. But those two things to me were kind of the epitome of very red flag-ish stuff. Like, so microcap management teams have no idea.
Don't you think they had to know about the covenant issue? I mean, like, it takes probably more than a week or two to get a waiver from JP Morgan.
Right. Well, I think they were reporting results, and I bet you they didn't think about the covenant issue when they were, because they were still meeting the covenants, but I'm sure once they reported earnings and whatever, they had to start. JP Morgan called them and was like, hey, let's talk about this, because you're dangerously close. And I'm sure in their mind, that's not something they've ever experienced. They've never had debt as a public company. They've never had to manage around covenants. And again, inexperienced, like, right? And so I think that was just something that was one of those things where, goes to my point, small cap management teams don't know how to manage secondary markets or capital markets or debt levels, and that's a risk. That's a real risk, and so you try to handicap that.
Yeah, I mean, one of the things that I've noticed is you get some of these companies that take on too much debt and they don't really control their. It doesn't sound like this in this business they really controlled their own destiny, and so
Right.
And so if you control your own destiny and your cash flows are stable, you can hold some debt. I don't know if maybe something changed where they thought that was the case and it turned out not to be the case, but it sounds like, where this story was headed with a covenant issue was not all that surprising to me as you started to describe the dynamics.
Yeah, I don't think they were nefarious, but they certainly signaled to the market that, now that we're bigger, it's much better for us. And, it made logical sense. Like, right. When you're an oligopoly and you become somewhat a duopoly in the market, you're, with lots of little guys still out there, then all of a sudden, it's not as bad, like, right. And they certainly, I don't think they were out there pushing it, but they didn't dispute it. I can tell you that, right? And so that's why that call was so surprising when they were like, "Oh no, we don't have visibility into what's going to happen this year." It was just like, but the other thing was just surprising that, again, on the shadow inventory issue, this is the part that I still don't really understand who these people were that were holding this inventory for $3 to $5 that they had at $3 to $5 for 5 years. And when the prices got up to $18 in the summer of 2017, they didn't dump it into the market at that time. Like, what were you hoping for? Like $30 gas price? Like, I wasn't really sure. Like, they haven't been 18 ever. Like, right. So you have these prices all time high, and like, you're not going to dump into.
You're not dumping that.
Yeah.
Did you ever get confirmation that the shadow inventory was actually there?
Well, it was just, I mean, I did not, like, right. But the fact that the demand there was more demand in the summer of 2018 than there was in 2017, but the prices were significantly lower. Clearly somebody was dumping that inventory. And the only way you could sort of see it is Amazon. So we were tracking prices. You could buy these big jugs on Amazon that if you want to do it yourself, replace your air conditioning gases, and those were a pretty good way to track it. And so, we were tracking those prices, and they were similar. And I saw them. I never saw, like, on the Amazon site or eBay sites where you could buy, like, 10,000 pounds of R22. Like, right, there was never anything like that. So it's hard to judge that. But clearly, there was some shadow inventory that somebody was trying to dump that caused it. So it just, again, one of those weird dynamics that I still don't understand, but and I will play dumb here in this particular situation because, but it was one of those things that was really hard to confirm, and the one guy that was trying to confirm it was biased.
Right. It seems like it seems like there were some things there that at least with the inventory issue that were some question marks around it. So you initially got into it thinking it could become take a balance sheet story, go to an income statement story, and then they did this transformational deal. How did you manage around the position, and did you take some off when people really liked the deal? And like, what was your thinking as time evolved? I guess my first question is, how long were you involved? And then sort of how did you manage this? And you mentioned hedging at one point. I'd be curious how exactly you hedged a MicroCap stock position.
There were options. There were options. There were short-term options available, and because it became like a hedge fund hotel in some way. Like I got into it really low, so I made like 200%. I certainly, have some portfolio management risk rules where I took a big part of it off. I did add to it once the stock price started dropping, and after the acquisition, because I thought the acquisition was a really good acquisition. It still made sense, and so that's sort of how I managed around it. I don't know if that helps you, but there were right when I said I'm going to give credence to these short reports and see what happens, and before that earnings call where like those two red flags popped up, I I had a hedge position in my position because the stock dropped precipitously after that earnings call.
There it is. So you hedge the position, the earnings call comes, they mention this covenant issue, and you think to yourself, oh crap, these guys don't control their own destiny. Maybe the shadow inventory issue is actually really real. Do you cut bait at that point? Is it just as simple as that for you?
Yeah, no, it's exactly what it was. It was like this clearest signal as you could have. And, you know, the thing is I am the more interesting, I'm much smaller. I was much smaller at the time in assets under management. So I didn't, you know, I was just trying to build a track record, and I had a few clients, a lot less than I do today. And so I can't, even though I'm still pretty small as a fund, I generally probably can't do that as well today than I could in 2 years ago. Just cut bait, like, or hedge like some of these positions. But yeah, but that, to answer your question, yeah, it was hedged. And so the moment they said that, I clearly recognized the hedge gains and sold the and sold the position, because yeah, that was scary. Like, yeah, all of a sudden their EBITDA, debt to EBITDA, went from like 2 to 12, right? And
yeah, all of a sudden they got to rely on the kindness of strangers to survive, and doesn't sound like a great situation.
Yeah, I mean, I can't. The CEO who just died was a young guy, and so can't imagine these last 2 years were good for him. I'm sure they were very stressful, and so that probably wasn't good for his health either. So I feel bad. So, but lesson learned. So
yeah, so that's all good. So if we're going to put a bow on this, what would you say the main 2 or 3 lessons you learned from this experience being involved with this company?
Yeah, that was one of the clear example where leverage in microcaps does not work. It's just not a good idea. Second, a confirmation of secondaries and microcaps are also a bad idea. They're usually a signal of more mismanagement to come, or it's more of CEOs thinking they become empire builders. Like when they do a secondary, is like I said, it's probably usually some investment bank whispering in their ears saying, hey, you can become an empire builder. Your company can be a mid cap instead of a micro cap, and look how cool all of our other mid caps are. And so that's always just something to keep in mind, that if that's what these guys are thinking. But I would say that was one of the rare scenarios where an insider / founder made a bad decision with his own capital, right? Mostly, and I wouldn't say that was a lesson learned. I would say this one in particular was more of a fluke where the guy was just too naive. But for the most part, I have found the guys with skin in the game will tend to be significantly more cautious about taking on those sort of debt levels or making these sort of acquisitions without having some sort of control over it or over the situation. I mean, there's like 3 of us here. Like, you know, if you had $25 million at play, or maybe even significantly more at the time, and you know, and you had an opportunity to make a transformational acquisition, but you had most of your wealth tied into this thing, would you not put like some sort of risk management into this? Like, would you like hedge your inventory prices, something like that? Like, not without, you know, have some sort of visibility where you feel confident. Like, am I stupid to think this? Like, what do you guys think?
I mean, I think I would sort of agree that if I could hedge my exposure, I certainly would. I don't know what the actual ability to hedge refrigerant, coolant, air compressor prices really is, but you know, I mean, in my experience, having properly aligned management and having a lot of skin in the game, like you described, is very important. But you just have to recognize that people are people; they make mistakes, and so people are, you know, they're going to take. The decision-making process, I think, is they're going to take it more seriously if it's their own money, but they can still be wrong every now and again. So
yeah, people are fallible, but that's the part of the process.
Sure. I want to make sure I have some sort of insight in the input costs or some strong opinion or idea of where the input costs are going to go. I mean, you need to have some visibility into the industry.
If they don't, and the real question is like, do we really control our own destiny here or not? I think is the real question when you take on a deal like that, because in my mind, I mean, Eric and I have both been involved in companies where there's a big shareholder that has a lot of. We've been involved in situations where there's a big shareholder that has a lot of skin in the game, but the stock looks cheap. It's a balance sheet story that maybe could turn into an income statement story, just like you're describing. And they don't. At the end of the game, they don't. At the end of the day, they don't really control their own destiny. And so if there's, and again, leverage. If you have a lot of leverage and you don't control your own destiny, it's that can be explosive, right? It's a powder keg of potential that could potentially blow up.
Yeah, I mean, like the other thing to think about is the difference between micro caps and small caps and management teams, and larger ones that you had asked this question earlier. What's the main difference? And you can have like a CBS or I don't know, like a Philip Morris. These are multi-market, multi-product companies that have multiple revenue and profit streams that are diversified, where they can take on these debt. And one of the more interesting things about, or not interesting, but different things about the microcap or this nano-cap space is these tend to be one market or one product sort of, or one industry minded things where you are sort of at the whims of that industry or of that product. So there is significantly less diversification for the debt writers or whoever, for the lenders, and obviously significantly more risk for the equity holders, because these companies will tend to trade much more volatile. They become equity stubs essentially if things go wrong. And so like that's why you can, that's why you can lose up to like 80% trading session if the debt's bad. And you don't want that, like, right? And so, and I try to be a Warren Buffett value type of investor. So that was, like I said, a very interesting lesson. It didn't hurt me as much, but yeah, it was annoying.
Well, I mean, the lesson I think is that debt is sort of like a tool. It's a tool like anything else. It's like fire. It can heat your home or it can burn your house down. And I think if I'm hearing what you're saying is if your house is really tiny, it can get burned down very quickly before anybody shows up to put it out. And I think that there's a lot of truth and insight to that. I think a lot of beginners in investing might take well to heart. Yeah,
the story, I do remember this from undergrad. I had this, in retrospect, he was a big blowhard corporate finance professor. He talked about the big game, but he did teach an interesting lesson that I won't forget. Like, that probably a little bit simpler to digest, but no pun intended, but debt is like mac and cheese, and especially relevant to college students. Everybody loves mac and cheese. You can eat a bowl here and there and it's cheap and whatever, but if you eat a whole lot of mac and cheese, you're going to get sick really, really fast. So there's always like a really good ground. Like a bowl or two of mac and cheese is okay, but gorging yourself on mac and cheese, you get sick really, really fast. So there's that's probably more one that anybody can relate to, is right, don't overeat the mac and cheese, and don't overplay with fire. So and I think a lot of these guys don't realize the capacity of their stomach for what they're doing. So
yeah, that makes a lot of sense, Peter. This is a great story.
Yeah. Peter, where can people find out more information on you? I hear you have a Twitter handle. Is that right?
Yeah, I tweet on it less. Artko Capital. That's my fund. I certainly don't try to market myself on there. That's more of a sarcastic thing, and occasionally I will discuss a thought here and there. But I found that there's a lot more trolls on the internet, and I just don't want to engage with them. So I tend to stick to kind of a few funny jokes here and there, or thought occasionally. And then the other thing is my investors pay me money to make investment decisions, and so, or pay me fees. And so why would I give away the cow for free on on the internet, so I tend to do that less. But so if you're interested about the fund, is info@artkocapital.com, is ARTKO Capital is a good email to send for documents for qualified investors. And if you're just looking for a conversation, I'll occasionally respond on Artko if it's a low key afternoon or something like that. So those are the two kind of good ways to fund.
And Peter, you write some pretty great letters. So if they email you at info@artko, would you put folks on your distribution list to get your communications and everything where you share your thoughts?
Yeah, this might be the most difficult question you've asked so far, because I'm really, this worked really well for like the first 5 years of distributing my letters, but I'm actually trying to figure out whether I want to cut that down and just only have it's for my investors and a few prospective investors. And I don't know, I haven't really enjoyed I try to be very transparent, but it does bring a lot more critics, and that makes your life unpleasant. And so I've been trying to figure out whether that's something I really want to continue. So maybe. So the short answer is maybe.
Okay.
Well,
so my hope for you is that your life is filled with pleasantness. So I'm not. We're not going to throw that out there. That they'll definitely get put on the list to get your ideas.
Well, Gary, with friendship like yours, it's always filled with pleasantness. So thanks for inviting me. This has been fun Thursday morning with coffee and good conversation.
Yeah, thank you, Peter. I appreciate
you being here. Yeah, and we're having guests like Peter on. This is going to be a regular part of what we're doing. We'd like to meet some smart people and learn about their battle scars. And so, Peter, if you know anybody else that you think would be a good guest, send them our way. And if anybody's listening to this that would like to come on, feel free to reach out to Eric and I, or Eric, where can they find us?
Yep, you can find us on our blog, www.accretivewealthpartners.com. We have our Facebook, we have our LinkedIn. Feel free to like or subscribe to us in there. We're available anywhere podcasts are available, also in the markettrenches.podbean.com. And you could also find us on the SNN Network website, snn.network, or the SNN Network YouTube channel, youtube.com/SNNwire. Peter, thank you so much for joining us. We really appreciate it. Thanks for sharing the story, and we'll talk to you soon.
Thanks, guys.
Thanks, Peter.
The information in this podcast is educational in general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.